following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU or Cable TV 10 in New Bern. Also, some of you may be streaming from our website, dlblain.com, and we welcome all of you. If you have any comments or questions on the show, please get in touch with us. We love to hear from our viewers and listeners. A lot of the ideas for our show come from you. You know, we want to talk about things that are relevant to you out there, what questions you have, topics you'd like to cover. So give us a call or email or visit the website. Our phone number is 252-633-0107. Our email at the show is allthingsmoney@dlblain.com. And the easiest way to get in touch with us, head on over to the website, dlblain.com, and click the big Contact Us button. So we've got a lot of stuff to go through. End of the year coming up. Always a crazy time if you're in the world of finance or taxes, politics, things like that. And this year is no shortage. I wanted to start off, though, with something about investing we talked a few weeks ago about, and just to kind of reiterate that we saw somewhat of a sell-off after the election and then a rebound later in the month. And so the month of November is turning out to be, you know, break even, a little positive, maybe a little negative, but certainly nothing like it was in the beginning. And so I just want to reiterate to investors out there that, you know, the overwhelming evidence is that markets are not predictable, whether they be stock or bond or inflation or things like that. In the short term, they're just not predictable. And there's always a lot of weighing of positive news and negative news in the markets by participants all over the world that have different competing interests, you know, short-term, long-term, need money for college, need money for retirement, need money for next week. All these competing demands and different viewpoints go into the market to create a reasonably efficient marketplace. And so people that tend to think, well, I know that Europe is going to collapse, or I know that inflation is going to go up. In fact, we're going to talk about inflation next. You know, these are just not realistic predictions. To think that you sitting there have more information than, you know, millions and millions of people around the world. And so unless you have access to some sort of proprietary inside information, which is illegal in the case of companies. Now, if you're a congressman, it seems okay to trade on information that you learn in negotiations with the Treasury Department, as we've talked about earlier. But anyway, the average person, unless you have some inside information, it's just not realistic. And so we think the best way to capture growth over time is to stay invested in a portfolio that's designed to meet your tolerance for risk, meaning your tolerance for volatility, the up and down of the markets, whether they be stock or bond, commodities, anything is subject to ups and downs. And when you can design a portfolio that meets your tolerance for risk and stay largely invested over time, that's the best way to meet your goals. If you feel like the risks recently have become overwhelming and you just don't know what to do, well, you can call us. We'll, of course, help you. But short of that, a couple things you can do is think ahead. Before going to cash, you know, a lot of people say, well, I'm going to cash out. And there's nothing wrong with cash if it's part of your overall philosophy, if your investment strategy. What we don't like to see people do is, you know, all in the stock market and then all in cash. If you have a very low risk tolerance, cash should be part of your portfolio at all times. There's nothing wrong with that. Just remember that it provides no defense against inflation for a long time. It does protect against downturns in the market because it doesn't fluctuate, but it provides no protection against inflation. Number two is if you go to cash, when will you get back in? And this is the trickiest part of it, that a lot of times there are sort of looming clouds on the horizon, economic things. In 2007, some of the financial crisis things were evident. The question becomes getting back in. And if you decide to reduce your risk, that's fine. But most people do not have the ability to get back in a timely manner, and so end up missing out on a lot of the gains from the rebound. So we just encourage you as we go through the end of the year, there's going to be a lot of talk about the fiscal cliff and debt and things like that. And just ask yourself, do I know more than millions of other people around the world? And, re-examine your risk tolerance. We'd rather you focus on a portfolio that you can be invested at all times. And remember, too, that being invested does not mean just sticking it all in the U.S. stock market. We believe that people should be diversified over different sectors of the economy, different countries around the world, with a good, healthy dose of high-quality bonds to tamper the ups and downs of the market. Commodities and real estate should also be part of most people's portfolio to help smooth the ride. Okay, so just wanted to start off with that. As we come into the end of the year, we're probably going to see more and more volatility, and we want to make sure that people don't get spooked out for the wrong reason. I mentioned talking about that a little bit about inflation, and this is one of the things that I'd like to point out. Ever since the financial crisis 2008, the Federal Reserve, the Treasury have been printing money, stimulating, pumping money into the economy, and people have been screaming, inflation, inflation, inflation. In fact, TIPS, Treasury inflation protected securities, right now are basically priced for a negative yield, a clear sign that people are expecting massive inflation ahead of time. And the official CPI rate, the Consumer Price Index, has risen about 2% over the past 12 months. And with gas and food have gone up much more than that, but the official inflation rate has been around 2%. And I've talked about this before, that inflation is a monetary phenomenon. It's not a price phenomenon. And what I mean by that is, yes, the price of gas has gone up. Yes, the price of food has gone up. But those are supply and demand issues driving the price up. And inflation, in a pure economist, that's just rising prices. Pure inflation is wage and money supply growth spiraling out of control. And so if you have, it's too much money chasing too few goods is essentially the layman's explanation of inflation. And so people intermingle these terms and they say, oh, gas prices went up, that's inflation. Well, that's not inflation if it went up due to an imbalance in supply and demand. And so what we're talking about here is true inflation like you had in the 70s and 80s. When we get back, I'll talk about why I don't think we're going to see a return to those extremely high inflation rates anytime soon. So for All Things Money, I'm your host, David Blain. I'll be right back and continue our discussion of inflation.